Imagine waking up to a single headline: SpaceX is going public. No leaks. No rumors anymore. The S-1 is filed. The ticker is reserved. In 90 days, you could own a piece of the most valuable private rocket company in the world. And your first instinct is the same as everyone else's. Buy. Buy as much as you can. This is generational. This is the next Tesla, the next Amazon, the once-in-a-decade chance everyone talks about missing. Here's the problem. That instinct, the one screaming at you to buy on day one, is exactly the instinct that has cost retail investors billions of dollars across nearly every major tech IPO in history. My name is Nick, and today we're going to walk through a hypothetical scenario. What would actually happen if a company like SpaceX went public, what the mechanics of an IPO actually mean for someone like you, and why the most important decision isn't whether to buy, it's when, and at what price, and whether you understand what you're actually buying. Let's start with what almost nobody understands about IPOs, even people who bought into a few. An IPO is not a sale where the company is trying to get you a good price. It's the opposite. The entire purpose of an IPO, from the company's perspective, is to raise the maximum amount of money for the existing shareholders and early investors, while creating enough public excitement that the stock pops on day one, generating headlines that make the company look unstoppable. That headline-grabbing first-day pop you read about, stock up 40%, up 80%, sometimes more, sounds amazing if you got in at the IPO price. But here's what almost nobody's selling you on IPO excitement mentions. Retail investors almost never get the IPO price. That price is reserved for institutional investors, hedge funds, and connected accounts. By the time the stock is available to you on your brokerage app, it's already trading at the inflated opening price, the one that already captured most of the excitement-driven gain. You're not buying low and watching it pop. You're buying after the pop, hoping there's more room left. Let's look at what's actually happened with comparable high-hype IPOs, because the pattern is remarkably consistent. When Meta, then Facebook, went public in 2012, it was one of the most anticipated IPOs in history. Everyone wanted in. The stock opened around $42. Within 4 months, it had fallen below $18. People who bought on day one out of excitement lost more than half their investment before the company found its footing over a year later. When Uber went public in 2019, after years of hype, billions in private valuation, and constant media coverage, the stock actually fell on its very first day of trading. People who'd been waiting years to finally own a piece of Uber watched it drop nearly 8% before the closing bell even rang. This isn't rare. This is the norm for hype-driven IPOs. The excitement that builds for years before a company goes public gets front-loaded into the private valuation and the opening trade, and then reality, earnings reports, and actual business fundamentals take over. Sometimes that reality is great. Often, in the first year or two, it isn't. So let's apply this thinking to our hypothetical SpaceX scenarios specifically. First, valuation. In private markets, speculative valuations for high-profile companies are often extremely aggressive, built on optimism about future growth rather than current, provable profit. If a company carries a massive private valuation built on the promise of future contracts, future launches, future colonization of Mars, a public market doesn't have the patience that private investors do. Public markets demand quarterly proof. Private markets can run on a 10-year story. The transition from one to the other is where many high-flying private valuations get tested hardest. Second, revenue concentration. A hypothetical aerospace company like this would likely depend heavily on a small number of massive contracts, government contracts, satellite constellation revenue, a handful of major commercial clients. Concentrated revenue is risky revenue. If one major contract shifts, gets delayed, or goes to a competitor, the stock can move dramatically on news that has nothing to do with the long-term mission of the company. Third, and this is the part most retail investors don't think about, founder-controlled companies often go public with special voting structures. Multiple classes of stock where the founder's shares carry 10 or 20 times the voting power of the shares you'd be buying. You could own a meaningful dollar amount of the company and have functionally zero say in its direction. That's not necessarily bad. It's just something you need to know you're buying into. Now let's talk about why so many people buy into IPO hype anyway, even when the data clearly says wait. It's not because they're bad investors. It's because FOMO is one of the most powerful psychological forces in markets, and IPOs are engineered through media coverage, through countdown clocks, through "this changes everything" messaging, to maximize that feeling at exactly the moment you have the least information and the highest emotion. Think about the structure of IPO hype. For years, you hear about the company. You watch it dominate headlines. You develop a relationship with the brand, the founder, the mission. By the time the IPO actually happens, you don't feel like an investor evaluating a financial instrument. You feel like a fan finally getting access to something you've wanted for years. And fans make terrible buy low decisions. Fans buy because they want to be part of the story, not because the price reflects the fundamentals. That's the exact emotional state that IPO marketing is designed to create. The single most useful question to ask yourself in this moment is, would I buy this stock at this price if I had never heard of the company before today? If the answer changes once you remove the excitement and the story, that's your signal that emotion, not analysis, is driving the decision. So if buying immediately on IPO day is usually a mistake, what does a smarter approach actually look like? First, wait for the lockup expiration. Most IPOs have a lockup period, typically 90 to 180 days, during which company insiders and early investors are contractually prohibited from selling their shares. When that lockup expires, a wave of selling often hits the stock, because insiders who've been waiting years to cash out finally can. This frequently creates a second, more honest price discovery moment, well below the excitement-driven opening trade. Second, wait for at least 2 to 4 earnings reports. A private company's internal projections and a public company's audited quarterly reality are often two very different stories. Give the market time to see actual revenue, actual costs, actual guidance, not the narrative, the numbers. Third, understand the float. The float is the percentage of total shares actually available for public trading. A small float relative to total shares outstanding can create artificial price volatility, wild swings that have nothing to do with the underlying business, and everything to do with limited supply meeting concentrated demand. Fourth, separate the mission from the investment. You can think a company's mission is genuinely important and still recognize that the stock price, at a given moment, has gotten disconnected from the business fundamentals. Believing in space exploration and believing a particular stock is fairly priced today are two completely different judgments. Let's walk through what this might actually look like with real numbers, using a fully hypothetical example. Imagine our hypothetical aerospace company opens at $85 a share on IPO day, after a private valuation that implied a price closer to $60. That's already a 40% pop baked in before retail investors get access. Excitement carries it to $110 within the first week. Financial media calls it the trade of the decade. 3 months later, the lockup period expires. Early investors and employees who've been waiting years sell a portion of their shares to realize gains. The stock drops to $78, below even the original implied private valuation, not because the business got worse, but because supply finally met the market. 6 months in, the first full earnings report as a public company arrives. Revenue is solid, but guidance for the next quarter is more conservative than the hype suggested. The stock dips again to $70. A year in, the business is performing reasonably well, but the stock is sitting roughly where the original private valuation suggested it should be, not where the emotional opening day price suggested. The investors who bought during the excitement at $95, $100, $110 are sitting on losses. The investors who waited for the lockup expiration and the second earnings report, buying around $72, are sitting on a position that reflects the actual business, not the emotional spike. Same company, same eventual outcome. Completely different experience, based entirely on timing and patience. Now, to be fair, there's a counterargument worth taking seriously. Some companies do continue climbing immediately after their IPO and never look back. If you wait for the smart entry point, you might simply miss the run entirely. Amazon stock, decades later, makes anyone who bought on day one look like a genius regardless of what happened in the interim. Survivorship bias is real. We remember the companies that justified the hype and forget the ones that didn't. The honest answer is that nobody, including people who sound extremely confident on financial media, can reliably predict which IPOs will be the rare exception versus the common pattern. What you can control is your position sizing and your expectations. If you want exposure to a hyped IPO, treat it as a small speculative position, money you can genuinely afford to see cut in half, not as a core holding you're betting your financial future on. Here's the actual takeaway from all of this. A high-profile IPO for a hypothetical SpaceX or any company that captures public imagination this completely will generate enormous emotion, enormous media coverage, and enormous pressure to act immediately. That pressure is not an accident. It's the predictable result of how IPOs are marketed and how human psychology responds to scarcity and excitement. You don't have to participate in the first week to participate at all. You don't have to buy at the emotional peak to eventually own a piece of a company you believe in. The investors who build real wealth from these moments are rarely the ones who bought fastest. They're the ones who understood the mechanics, waited for real information instead of hype, and sized their position according to what they could actually afford to be wrong about. The rocket doesn't care what day you bought the stock. The math does.